Welcome to Stock Shots. We are so pleased to have legendary investor and author Mr. Jim Rogers back with us on Stock Shots tonight. The full video can be seen at www.stockshots.tv. That's www.stockshots.tv. Thank you for listening. Our guest today is Jim Rogers. Mr. Rogers, thank you for coming back on Stock Shots.
Well, I'm delighted to be here.
Jim, last time we talked was about the first week of March, and at that time it seemed like that none of the traders had any confidence in the Federal Reserve. And then when Bernanke came out and did what he did with regard to Bear Stearns, now it seems like he can do no wrong in the eyes of the street. Has your opinion on the Fed changed since our last discussion?
Well, he came out and bailed out a few financial types and made sure they didn't have to give up their Maseratis. So, of course, they're happy. But this is short term. In the end, in the longer term, these actions are going to have disastrous results. Disastrous results on the dollar, on inflation, on the financial system, and perhaps even on the Federal Reserve. So everybody should maintain while the sun shines, because it's not going to last too long.
We had economist John Williams on our show last week, and John contended that while we have seen some inflationary pressures, what we have seen has basically been produced by the rising energy costs, and that we've not yet seen the effects of this monetary inflation that is being created by the Fed. Do you agree that the main monetary inflation is yet to come?
Well, all of it is yet to come. I don't think John's quite right. The price of tin is at an all-time high. The price of lead, the zinc, all these things have been skyrocketing. I think that the Fed has been printing money, much too much money for too long, and it is now, certainly since August, they've just been running those printing presses as fast as they can, and of course it's going to get much, much, much worse. So John is right that there's more to come, but it's caused by a variety of factors, has been and is and will be caused by a variety of factors.
Last time we spoke, you basically said that we needed to go ahead and deal with the effects of the recession right then, that you wanted to see us go ahead and clean things out, start over from a sound base. Now we see the government coming out with a bill that Arnie Frank sponsored to kind of prop up the housing market. Do you see this as just yet another patch from the government when we should be letting the free markets operate?
Well, of course it's another patch, and the worst of it is, you know, all the poor people who went out there, saved their money, made their payments, didn't get overextended, now look like idiots. I mean, I can think of many people I know who went to work every day, wouldn't think of buying a house they couldn't afford, wouldn't think of falsifying their income statements, and now, of course, the people around them who did all of those things, who did not live a prudent life, are getting bailed out. They look like geniuses. I don't think that's the way the system is supposed to work. Not the way I think the system should work. And, of course, bailing out a few people, in the end, it's going to cost $300 million of us, actually $6 billion in the world, but certainly in America, that $300 million, it's going to cost us even more because inflation's going to be worse, the dollar's going to be weaker, so all of us are going to have to pay the price to bail out a few thousand, a few hundred thousand people who didn't live life the way most of us were taught to live and the way history showed that if you're going to be successful, you should live.
I agree totally, and I hate to see any kind of government bailout. I really didn't think that the economy was in the state that we needed this stimulus package. And we all know that the checks are in the mail now. Some people are beginning to receive them, but do you think that the stimulus package is just going to accentuate the problems that the Fed has already caused, or do you think that's going to be minor on the scale?
Well, it's minor on the scale because it's $100 billion or so. Not that that's not a huge, gigantic amount of money, but relative to the U.S. economy and relative to what's happening, it's not very much. It is going to make the situation worse. The government's borrowing that money to send out to all of us. And of course we're all happy to get it. But in the end, we got to pay it because it's government taxes, government borrowings. So it's just taking it out of one pocket and putting it in another pocket. So we got to pay it back one way or the other eventually. So No, it adds to inflation, it adds to the deficit, it adds to higher interest rates eventually. You know, the amount of money we all receive, oil prices have already gone up enough to offset it already.
Yeah, the oil prices just won't seem to stop, and that was one of the things that I wanted to ask you about. We hear a lot of the pundits talk about the relationship of oil to the dollar, and as the dollar continues to fall, oil will go up. Is that direct relationship going to continue, or is oil going to, do you think oil can continue to go up because of the global growth story, even if the dollar does strengthen somewhat?
Well, the dollar is not the reason oil is going higher. Oil is going higher. The same reason rice and everything else is, because there's not enough oil. Supply and demand are out of balance. Declining dollar is icing on the cake. That makes it even more attractive, but even if the dollar stays flat or goes up, price of oil is going to go higher. There's not enough oil. It's a very simple equation. If there were a lot of oil, the people with the oil would be jumping on investors' heads. The facts are Exxon doesn't have a lot of oil. BP doesn't have a lot of oil. Nobody has a lot of oil. That's why prices are going higher, and because a lot of other people want to use oil. I mean, it's a very simple economics. The dollar is a minor player in this whole big scheme.
Well, in looking at oil, is there enough if we open up drilling in the Outer Continental Shelf in an ANWR, or is this, are we past the point that can help?
Well, who knows? I have no idea how much is in the continental shelf or ANWR, but I know it's foolish not to look and see. Will it solve the problem? Well, it might someday if there's a lot there, but remember, it will take a decade or so, even if we all started drilling today, or said yes today, because you couldn't start today. If somebody said yes, let's explore all these areas. If there's oil, it would help someday, but someday is a long way from now. Our problem is in 2008, 2009, 2012, 2016. Problem is here now. Every oil field in the world, nearly every oil field in the world is in decline. You know, they're not going to wait around. Oil fields that exist now are not going to stop declining no matter what happens.
And, you know, we heard one of the investment banks come out a couple of weeks ago and said oil could potentially retrace back down to $70. I don't see that happening, but in the face of this global growth, if it did go back down to 70 on a drop in the speculation, the premium that's factored in for speculation, you don't see it staying at levels down there for very long, do you?
Well, of course not. Yes, it could go. I mean, if bird flu suddenly wipes out Europe, of course oil will go down. Everything will go down. Stocks will go down a lot more, by the way, and stay down longer. But sure, but if oil goes down to 70, that's going to make the problem worse, because then people are going to continue to use oil. The demand for oil is going to stay high. Fewer people are going to look for oil. You know, high-cost exploration and high-cost production will not occur. That's just going to make it worse.
For the rest of this video, please visit our website at www.stockshots.tv. That's www.stockshotz.tv. Thank you for listening.